Good morning, Bree. I'm not putting my video on today. I got lazy. See if anybody else shows up. Give them a minute or two. Want to go outside? I'll start at 8:02. All right, I'm going to get started. So the other day, I asked you guys to take a look at the video that I did, probably the first 50 minutes of it. And I'm actually going to go back and rediscuss a little bit with you depreciation, just so you're okay with it. Do you have any questions on any of the other parts?
No, not right now.
Okay, Bree, sounds good. So we're going to start talking about depreciation and then start looking at some examples of how, we define cash flow, because this is really an extension of Chapter 9. In Chapter 9, we said, oh, here's your cash flow, and now determine if you should take on the project. So Chapter 10 is digging in deep and going, well, how the heck do you figure out the cash flow? So that's all these different components. And then the final area of Chapter 10 gives us a couple more scenarios where we can use cash flow predictions to determine if we should replace equipment, how much we should bid on a project, or if we should do some cost savings. So it's just specific items that we're looking at there. And we'll look at those in pretty good detail, so you're cool with the homework. So coming back to depreciation, let me get could you see my PowerPoint okay?
Yeah, that's good.
Okay, cool. So depreciation, just to, I don't think you're an accounting major, so I know you probably aren't sitting there going, oh, I know everything about depreciation like an accounting major would or should. But it's really just taking the cost of a major piece of investment, like a building, equipment, furniture, and expensing it over time, instead of expensing it all in the year we buy it. And the major reason we have to do that is because the people who make financial accounting rules, where our result is our financial statements, basically say that's what we do. And the IRS also has said that to us. And the IRS, their end result is a tax return. So if they allowed us to just expense it all in the year we bought it, then there wouldn't be any reason for depreciation. So depreciation in the real world means decrease in value. It kind of means that here, but it's more rigid and systematic, meaning you can calculate it. You don't have to wait till the end of the year to see, well, if I sold this piece of equipment at the end of the year, how much would I sell it for? Okay, here's what it was worth in the beginning of the year. Here's what it's worth at the end of it. That's not how we calculate depreciation. It's all formula based. So, and that's allowed, and it's okay. So depreciation is important in our class because it has nothing to do with cash. So when we see depreciation on an income statement, we go, that's not cash flow. It's a non-cash expense. We're not paying for depreciation. It's just something we have to decrease this year because the people who make accounting rules said that's what we got to do. So it does impact how much taxes we have to pay though. So since depreciation is an expense allowed to be deducted each year to determine ultimate tax amount. We do have to be worried about it and its tax implications. Now, in our finance world, we have something called the depreciation tax shield. And we calculate that by taking the amount of depreciation for that year times the marginal tax rate. And that will tell us basically how much we're saving in taxes because we're allowed to deduct depreciation expense. Okay, now there's a couple different ways we can calculate depreciation. The one we use for financial statements is called straight line. That's the one 88% of companies who make income statements, balance sheets, public companies out there whose stock is being traded on a stock exchange. When you see depreciation on their income statement, they calculated it using normally straight line. And straight line depreciation, again, it's a formula. We take the original cost of the asset minus what we think it will be worth. So the company decides that, divided by the number of years we expect to use it. So that's something else we use to, we estimate. So when you see, like I said, depreciation normally on an income statement, that's how they calculated it, because it's very easy, straightforward. It's basically the same amount each year. However, that's not what's used for tax purposes. 99% of companies use what's called MAKERS. And MAKERS is just an acronym. You have to remember who makes the rules for tax returns. Congress and whoever's president. And Congress is full of lawyers. So they love these huge names for things that those of us who have not gone to law school go, what? Where did they find that? There has to be an easier name. But what MAKERS stands for is Modified Accelerated Cost Recovery. It was created in 1986, which is a good year. 1986. Before that, and you don't need to know this, but before that, from 1980 to 1986, we used accelerated cost recovery. And before that, you used whatever you wanted. But right now, so since 1986 to the present, we're using this method called MAKERS. And it's not, hugely complicated. It's not a formula you have to use. You just need to know some information about it so you calculate it appropriately. The first major thing you need to know about the asset you want to depreciate under MAKERS is what its life is. What its life is. And you don't decide that. The tax law actually decides that for you. And here's the basic rules. And they're at the top of page 323. And this is what you need to know for our purposes. If you have equipment, so if the asset you're trying to determine tax depreciation on is equipment, so that would be the MAKERS, it has a 3-year life. If it's a car, any kind of auto, any truck, except for a tractor trailer, a tractor of a tractor trailer. So any other kind of vehicle or computer systems. So your printers, your computer, your database, physical data storage areas. These all have 5-year lives. And then most everything else, other equipment, furniture, anything but real estate, so not a building, so they have their most industrial equipment, that has a 7-year life. So just use that, and they're not going to go into any other kind of assets in our homework or anything. Those will be the basic kind of assets you'll see. We just want to get you familiar with it. Once we know the asset's life, Then we go to a table that was created by the IRS, the Internal Revenue Service, because they take tax law created by Congress and the president and convert it into understandable language for us non-lawyers out there. And they created tables, and they're on page 323. And that's the table you're going to use to calculate tax depreciation or makers. And all we do is we say, okay, what was the life of the asset? Say it was 3 years. What year am I calculating depreciation for? The first year. Okay, then I'm going to take the cost of that asset times 33.33%. And that's the amount of tax depreciation. If it's the second year of that asset's life, you use 44.45%. And the third year, and then the fourth year. Now, if you're sitting there going, wait, you said 3-year life. Why is there 4 years of calculation? Because these tables are created, the very last bullet point, where it does this for all these assets that use this table. And they already built this in. We don't use partial year depreciation. In other words, if you didn't buy an asset on January 1, normally you have to say, okay, when did I buy the asset? May 1. Okay. How many months did I use that asset then for the rest of the year? 8. Well, then I can only take 8/12 of depreciation expense for that year. We don't do that for tax accounting. These tables are created assuming, or we pretend, all assets that you purchased that year that fall on this table, 3-year, 5-year, 7-year, were purchased on July 1st. So it automatically only calculates a half a year depreciation in the year of purchase, 6 months. So the first tax year, you get 6 months of depreciation. The second tax year, you get all 12. Then the third tax year, you get all 12. And then the fourth tax year, you get the other 6 months of depreciation. So over the life of the asset, you're going to record depreciation expense in 4 tax years, but it's really only 3 years worth of depreciation. That's how the 5-year and the 7-year are. You notice there's an extra tax year we're calculating depreciation for, and that's why. There's no salvage value at all looked at when calculating makers. We always take the cost of the asset times the applicable percentage. Any questions on that? We'll do some examples with it so you can see these things in action. Another important aspect of this calculation is determining after-tax salvage value. So we don't physically use salvage value in our computation of depreciation. That doesn't mean we don't feel it'll be worth something at the end. We could say, hey, we bought this piece of equipment for $100,000 today. It has a 7-year tax life. When we're finished using it, we feel it's going to be worth $2,000. We don't take that $2,000 and include it in our computation of depreciation. However, when we're determining overall cash flow from a project, we do need to take that salvage value into consideration. So if the salvage value, if the salvage value that we expect at the end is different from the book value of the asset, what's book value? It's what we paid for the asset minus accumulated depreciation. Now, if we're going to keep that 7-year asset for all 8 tax years, we're going to calculate all the depreciation. We're going to expense that $100,000 equipment over those 8 tax years. That means its book value will be 0. Will be 0 at the end of the time period. because we paid 100,000 and we calculated a total of 100,000 in depreciation. So when we're looking at a project, we have to say, well, we really expect to get $2,000 from that. Okay. If that 2,000 is greater than book value, which it will be in this case, when we get rid of that asset at the end of the life, we're going to have to pay income tax on that extra $2,000 we receive at the end of the life of the asset. So there's a tax implication. So first of all, we're going to say, what's our cash flow from this piece of equipment at the end? We're going to get $2,000. Okay. Are we going to have to pay any tax on that? Well, let's see. Take the $2,000 we're going to get minus the book value of the asset at the end, which will be 0. So we're going to have to pay tax, the T, on all 2,000. So we would take the tax rate times that difference, and that's the income tax we would have to pay on that $2,000. So how much will we really have in salvage value at the end? Well, we'll get the 2,000, but we're going to have to pay tax on that. So subtract the tax, and that's what we call after-tax salvage. So that's the overview. Let's take a look at some examples here so you can see it in action. You purchase equipment for $100,000, and it costs $10,000 to have it delivered and installed. Based on past information, you believe that you can sell the equipment for $17,000 when you are done with it in 6 years. Oh, okay. So there's its salvage value, and you're done using it at the end of year 6. I'm just going to jot that stuff down a little bit. The company's marginal tax rate, remember what marginal tax rate is? It's what the next dollar of income will be taxed at. And that's what we use to calculate tax implications from these cash flows. What is the depreciation expense each year? And then the after-tax salvage value in year 6 for each of the following situations. Now, before we go to the next slide, what's very important is that this equipment just didn't cost $100,000. It cost $100,000 plus the $10,000 to have it delivered and installed. So we say all costs we have to pay for beyond the purchase price of an asset to get it ready to use is included in the original cost of that asset. Again, note, we only plan on using this asset for 6 years. All right. Now, this company first used straight line. I'm not worried about that. I'm going to go to makers because that's what we'll be using. If this asset qualified as a 3-year asset, okay, if this equipment was being used in research, we would calculate depreciation using that table on page 323. 33.33%, which converted to a decimal, 0.3333. So the first year's depreciation on the whole asset, $36,663. Year 2, now we'll use the next amount down, 44.45%. We use the original total cost of 110, get the 48,895. So for tax purposes, we would deduct 48,895 on our tax return. Then the next year, 14.81%. And then the final year. Okay, so if you add these 4 amounts up, they're going to equal $110,000. So under this scenario, they want to know, okay, what's the depreciation each year if it was a 3-year asset, a 3-year class asset, we call that. We would calculate depreciation for 4 tax years and deduct it. What is the after-tax salvage value of this asset? Well, we know the salvage value is $17,000 at the end of year 6. Now subtract from that the tax on any part of the salvage value that would be used to determine tax. And that would be the amount the salvage value is above the book value of the asset. Each year, we would subtract the depreciation on this asset. So by the end of year 4, the book value of the asset is 0. So at the end of year 6, it is 0. So all $17,000 would be taxed. So we multiply the 17,000 by 21%, we get $3,570. So although we get $17,000 of cash on this equipment, we're going to have to pay $3,570 in taxes. So how much cash will we really have at the end of that 6th year from this? $13,430. Are there any questions on that? All right, let's look at one more scenario. Now it's a 7-year asset. Now this is going to be a little different. Remember, if this asset, this piece of equipment falls into the 7-year makers category, we are actually calculating depreciation over an 8-year tax year period. So let's do this. The first year, we would take 110,000, go to your 7-year column, 14.29%. That would be your result. There's your first year's depreciation. You could subtract that. That's taken out to determine book value. The second year, you're going to use 24.49. Go down the table. So the second year's tax depreciation under makers is 26,939. You would subtract that. Then 17.49. That result is also subtracted to determine book value. And it would also be subtracted on your tax return. Here's the end of year 4, 13,739. I'm just going down and using the next percentage on that table. Year 5, tax year 5, 9823 would be the amount, 8.93%. And then here's the final year, we would be calculating depreciation, 8.92, 9812. So we subtract all the depreciation. So at the end of year 6, we have not calculated 100% depreciation on this. We still have 2 more years to go, but we're going to get rid of this asset at the end of year 6. So the book value is $14,729. So when we're determining after-tax salvage value, it will be the $17,000 cash we receive, but all $17,000 will not be taxed. Will only tax the part of salvage value that is above book value. And here's why. In our first scenario, we were able to deduct all $14,729 on our tax return and get a full tax advantage for it. So what this is saying down here is, well, if you get a full tax advantage, then all your salvage value, all the money you get when you get rid of that asset should be taxed. But since you didn't depreciate or expense this asset all the way to 0, well, then we're not going to have you pay tax on all $17,000 that you receive. Subtract the part you never depreciated, which is book value, and multiply it by your tax rate, which would be let's see. I don't know if I did that. Nope. 2271 is your difference times 21%, $476.91. Subtract that tax, $16,523.09 would be your cash flow then on this asset after the after-tax salvage value. So for purposes of looking at our project, we have to include that cash flow of $16,523.09 as the end amount at the end of year 6. Are there any questions? Okay. So let's go into another problem. And actually, let's see what time it is. Okay, I'd like to, let's look at this one first. And then I think I'm going to go to the one in your book. I really like the Majestic Mulch and Compost Company. But this is one of our scenarios, our very first scenario actually, where they say, is this the one? Salvage in 5 years, 3 years. Okay, now this is I'm thinking of something different. Okay, so let's just take a look. We're thinking about replacing a machine we have. Here's the machine we have right now. It cost us $100,000. We have annual depreciation of $9,000. We purchased it 5 years ago. Its book value is $55,000. Its salvage value today is $65,000. If we keep it for 5 more years and not replace it, its salvage value will be $10,000. Okay. If we buy a new machine, it will have a 5-year life for maker's purposes. It will have no salvage value in 5 years. It will save us $50,000 a year more than the original machine does. We're going to depreciate this over a 3-year maker's depreciation. Okay. Required return that we want on our investment is 10%, and our current tax rate is 21%. So those are our variables. Let's take a look. We are interested in incremental cash flows. We talked about that. If we buy the new machine, then we will sell the old machine. What are the cash flow consequences of selling the old machine today instead of 5 years? So that's what we're looking at here. So first of all, if we buy the new machine, we will have $50,000 more in cash each year. Cost savings of $50,000. Now, what about depreciation? Well, the old machine would only allow us to have $9,000 in depreciation expense each year. We would lose that. What would we have in its place? Depreciation on our maker's table. So let's go back and see. Whoops. Our new machine cost $150,000. So we would take, it's a 3-year asset, page 323, 150,000 times for the first year, 0.3333, 49,995. That's where they get this. The next year, 150,000 times 44.45%. Then the third year, 150,000 times 14.81%. And then the final year, you would multiply that by 7.81. So we would have more, this incremental, okay, is showing us how much more in expense we would have for calculating our income taxes. So we would have $40,995 more in depreciation. Here we would have $57,675 more. Here we would have $13,215 more, $2,115 more. Here we would have $9,000 less if we bought the new machine. So what does that mean for our earnings? Earnings before tax. Here's your cost savings. So that's really a positive amount, 50,000. You would have 40,995 more in depreciation, so subtract that. So your earnings before tax would increase $9,005. In year 2, your inflows are $50,000, but your additional income to be taxed would be $50,000, but you would have $57,675 in depreciation expense, causing a negative or a loss for income tax purposes. Year 3, positive $50,000, but you would have extra depreciation of $13,215, causing that earnings before income tax to be at $36,785. Same thing with year 4. Take a look at year 5. You would have a cost savings of $50,000, okay, and an additional cost savings of $9,000 because there is no tax there would be no depreciation in year 5 on the new machine. So you would actually be saving $59,000 in total for purposes of calculating tax. That's not cash flow, that's for purposes of calculating tax. So now let's see what each of the tax implications is. So we're going to multiply each EBIT by 21%, our tax rate. So that's how those results were found. So in year 1, we would have an additional $1,891 of tax, causing our net income to be at $7,114, more than it would be on the old equipment. In year 2, because this would result in more expense, we would have less in tax, so our net loss is less, which would be $6,063. In year 3, we would have $7,725 more in tax, so that would cause the income the savings from that year on a tax basis to be at $29,060. We call it net income here. We would subtract the same thing here and here. So this is net income, this is not cash flow, but this is how we have to drill down and really look at the impact of making one decision over another. Getting rid of the old will eliminate this $9,000, and buying the new would cause these expenses to then be incurred. And then the overall tax implication. So once we do that, now we could start taking a look at cash flow. The cost of the new machine at year 0 will be $150,000. So that's an outflow. If we bought the new machine, we would have to spend that. But what else would happen at time 0? We would sell the old machine. So let me go back to our parameters here. Remember, here's our old machine. If we sold it today, salvage value is $65,000, book value is $55,000. So that means we'd sell it for $65,000. It still has a book value of $55,000. So not all $65,000 will be taxed, only $10,000 of it. So 10,000 times 21% or 2,100 would be the amount of tax on that $65,000. So we would have a net inflow after paying the tax on that of $62,900. So what is our ultimate net inflow or outflow on year 0? We'd have to pay $150,000. We'd get $62,900. So our outflow, $87,100. Now, if we weren't selling the old machine, we wouldn't have to do all of the steps 2 and 3. But it's because we're selling the old machine at year 0 that we have to show those impacts. Finally, the after-tax salvage on the old machine must also be looked at. What does this mean? Just because we're saying, okay, we're going to sell it in year 0, we're not done with it, because maybe we should have kept it. So what are we giving up at the end of year 5 if we kept the old machine and got rid of it then? We have to take that also into account. So we would have sold it, the salvage value was 10,000. Okay, at the end of the year 5, the salvage value and the book value would be equal. So there would be tax of 0 on that inflow. So the $10,000 would be actually considered an outflow in our case, because if we kept the machine, it would have been an inflow. But since we're getting rid of it in year 0, it's an outflow when looking at our decision here. That's something we gave up. So it's considered an outflow. I know that's kind of squirrely, but does anybody have any questions on that? Okay, so now here's what it all comes down to. And I'm going to go back to our other slide in a second. But here is the net capital spending. Here's what we have to spend net in year 0. Okay. Now let's look at our operating cash flow for the end of year 1, 2, 3, 4, and 5. Now we did that back here. But if you're sitting there going, oh, that's only 7,114 there. You have to remember, we have to add back. Okay, so we have 49,995 minus the 9,000 gives us the 40,995. Okay. So if we add the net of 40,995 to 7,114, let me go back there. So we're adding the incremental to the 7,114. That's our cash flow then. Same with year 2, take your 57,675. Now you're actually going to subtract the 6,063. So, come on, there we go. Okay. So the operating cash flow will be 51,612. That's where the year 3, 4, and 5 amounts come from. So that incremental change in depreciation is added back to either your net income or that net loss would be subtracted to determine cash flow. So now we have our annual cash out inflows. They're all positive. We have the amount of cash we have to spend up front. And we have the amount of cash we forgone, whatever. We forgo here because we decided to buy the new machine. So we gave up 10 grand at the end. So here's our annual cash flows. So that's the information we had back in chapter 9. Now we could do either a net present value analysis or an internal rate of return analysis to determine should we replace this asset, this equipment, or not. Let's take a look. So the answer is, not the answer was there. So if we compute the net present value on that 75,470, or I'm sorry, on those cash flows, we will get a net present value of 75,478 and an internal rate of return of 43.31%. So I'm going to just fly over to Excel quick. If you watch my video, sometimes I have such a hard time with Excel myself. But I get it after a while. Let me go into Excel. So but we always have to be practicing it. If you want to use the formulas in Excel, I'm going to go to net present value, which probably isn't the best thing for me to do, but I'm going to put my rate of returning because you're like, well, how'd they get that net present value? Well, if you went back, I'm just flying back to my PowerPoint here. The rate of return is 10%. That's what they're requiring. So we are going to then calculate this assuming a 10% rate of return. And then what we could do, actually I should do this in here, is put each of the values of our cash flow into our spreadsheet. So let me do that. 48, 51, 6, 12, 42, 275, 39, 944, 27, 6, 10, and our initial is 87,100. Okay. So at year 0, I have 87,100. Then year 1, this is right off that spreadsheet we did within the PowerPoint. Year 2, 42,275. Year 3, 39,944. I think that's right. That doesn't look right. Yep, it's right. And then year 4, 27,610. So now we just need to find that net present value. So again, your rates, and then the cells beyond year 1 or beyond year 0. So C4 to C7 is my group of cells. And then I think I put a little comma and plus C3. And there we go. So my formula is right there so you can see it. So the first thing you're going to put is your rate followed by a comma. I always get tripped up on those dang commas. Then you want to do your cash flow series. So at the end of year 1 through whatever amount of time. So it's only going to be looking at these cash flows from year 1 through year 4, C4 through C5. I have those in parentheses so they know that's the range, comma, and then I put a plus year 0, C3. Close up your parentheses or else you'll get an error or it'll suggest something. But that's how we get that net present value. Internal rate of return is much easier to calculate. Equals IRR, and then just put your range of all cash flows, C3 to C7. And you get 34%, which I'm going to make 34.1%. Okay, or you could do it in your calculator. Uh-oh, I did something wrong. I always do something wrong there. They're getting a different one. Anybody know what I did wrong? I did it wrong the other day too. What did I do wrong there? Anybody see my error? I always forget. Well, let's see. C4. Ooh. I'm doing wrong. Uh-oh, thank you. Who's doing right? Yeah, me too, Brady. Let's use our calculator. Let me see something really quick. I did it wrong in the explanation too. I stink at this sometimes. IRR in Excel. When in doubt, you know what we do? We Google, right? Yeah. Internal rate of return. Da, 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 da. Formula for calculating internal rate of return. I know. Okay. I'll figure it out. I'm not going to drive you guys crazy right now, but I thought that's how let's do this. When in doubt, also, we could use the formula box. Maybe it'll tell me in here. It's the rate of cells that contains numbers for which you want to calculate the internal rate of return. There is C3 to C7. What's the problem? I'm not going to put a guess. Maybe the PowerPoint's wrong. Let me use my calculator, 1 second. Because we always have that option, right? So I'm going to go into my apps, finance, and then my internal rate of return. And then I have to enter my numbers in manually. So negative 87,100, comma, 51,612, comma, 42,275, comma, 39,944, comma. Do my numbers look right in the cells? 27,610. Close the parenthesis. Again, an error. I'm aggravated. Oh, I know what I did wrong there. Sometimes these things are a pain in the butt, aren't they? But they're quick solvers. This is bothering me, so just give me a second. 87,100, I think I need to use a bracket there. And then put my cash flows in, 612, comma. Don't forget your commas. Don't forget to use a bracket when you need to use a bracket. And then 27,610. Close the bracket, close the parenthesis. Yeah, the PowerPoint's wrong. It's 34.10%. Holy moly, that was driving me crazy. So this is wrong. Let me go back over and share that with you. I just put it through on my calculator. This should be 34.10%. Sorry about that. So either way, even though it's wrong, we only wanted a 10% return on this investment. So obviously we would take this on. We would replace the equipment. Okay, so there's other ways to determine operating cash flow. So once you have a pro forma income statement, okay, meaning you know your net income, you have all of your inflows, your incremental inflows or cost savings, you have your incremental cash outflows, you know your incremental depreciation and incremental taxes, you can then fast track it a couple different ways. And it's use whatever method you're comfortable with. When you want to find operating cash flow, which is what we did in that second table, you could take net income plus the depreciation. Okay. If you want to find operating cash flow, you can go the opposite way. You can go sales minus costs minus taxes. So then you're not even deducting depreciation. And that's the assumption here. There's no depreciation in the costs. Costs should be incremental cash outflows. Or they say, use the tax shield approach if you want. So it's whatever you feel most comfortable with. This is where we take all of our sales minus costs. So that's the part of sales that will be taxed. They do it in a fast track. They go, okay, instead of multiplying that difference by the tax rate and then subtracting that result from sales minus costs, there's an easier way. If your tax rate is, say, 21%, what does that mean related to your sales minus costs? How much will you keep as cash flow? Well, if you have to pay 21% of them as tax, take the difference between 100% and 21%, you're going to keep 79% of this difference as cash flow. The other thing you're going to keep is the tax on depreciation. Okay, I don't think they give you an example here. Let me see. This is cost cutting. So let me show you that really quick, what they're talking about, those three scenarios. Let me grab a. So I like that they have an example on page 329. I'm just going to use their numbers. their sales are 1,500. And remember, these are incremental from taking on the project. It's not total for the company. The cost related to these incremental sales will be 700. The depreciation from whatever the heck that they are using for this project, so this is incremental, 600. So, and we could represent that as 700 minus 600 minus. So on a normal income statement, sorry, I don't think you guys can see that. Let me go back so you can see what I'm doing here. On a normal income statement or tax return even, there's our net income before taxes. So earnings before interest and taxes. We would then determine the tax rate. The tax, I mean. So that would be 200 times 21%. And actually we can show that as a minus. So our net income would be that 200 minus $42. Okay, so for a lot of us in finance, we're not figuring that out. Accounting figured that out. We just need to know what to use from that to figure out our cash flow. Well, the first one says, okay, do a bottom-up approach to determine operating cash flow. That's where we would take our net income of 158 and add back depreciation. So we quickly got to our operating cash flow by taking our net income and adding back the depreciation that was deducted. So maybe you go, I like that. Well, then there's the top-down approach. And that says, take, and this is on page 330, take your sales, it's right there, minus your costs, minus your tax. You get the same result. You're just finding it whatever you feel most comfortable with. Then there's the last approach. It's called the tax shield approach. And it says, okay, first of all, I'm going to write it out here. Take your sales minus your costs. Multiply that by 1 minus the tax rate, which is 0.21. So essentially what that is saying is, and I'll show you the long way of getting to that. You're going to have $800 that will be taxed at 21%. Definitely. So did that wrong. Your tax will be definitely $168 on that. All right. So take the 800 minus the 168 in taxes. What this formula does is fast track that two-step process. It says, of the 800, you're going to keep 79% of it. That's all that's doing. Further, we're not done. You do have some more tax savings because you will be subtracting depreciation when you compute your taxes. So add to this the tax savings you have from depreciation, and that would be depreciation times your tax rate. So if we take our depreciation times 0.21, we have an additional tax savings or cash flow because we're not going to pay $126 in taxes. So how much is our ultimate cash flow? The $632 we keep after paying tax on the 800 plus the 126 we save in taxes, or $758. And if you're going, whoa, it all depends on what you're comfortable with. You know, somebody who's really into accounting and gets that whole understanding of sales minus costs and the effect of tax, they're okay with the tax shield approach. We're just showing you there's different ways to get there. And all you need is this pro forma income statement to help you get to your operating cash flow. Are there any questions on any of those? Excellent. So let's do another example through our PowerPoint presentation. So I'm going to go ahead back over. We'll share that with you guys. Come on. Okay. So here's another example. Your company is considering a new computer system. It will initially cost $1 million. So if you want to jot any of this down, you can. We're going to go to an Excel spreadsheet as well to show you how you can quickly do these computations. If you want to use Excel, you're more than welcome to use your calculator. This new machine is going to save $300 per year in inventory and receivables management costs. Great. The system is expected to last for 5 years and will be depreciated using 3-year makers. This system is expected to have a salvage value, though, of $50,000 at the end of year 5. There is no impact on net working capital, so there's no additional investments necessary up front in our current assets or current liabilities. The marginal tax rate is 21%, and we would like to see a rate of return of 8%. So I'm going to click on the little Excel icon, and then I will share that with you so you can see that in case you didn't. So here's our information. First of all, let's calculate depreciation on this each year. So let me go back up here. Here's our scenario. We have a piece of equipment that will cost us $1 million up front, year 0. We're going to save $300,000 a year in management costs. Tax rate's 21%. We expect to sell it for $50,000 at the end of year 5. And we would like to have a rate of return of 8%. Let's calculate the depreciation each year on that $1 million using our 3-year table, 3-year column in our table on page 323. The author already populated these cells with the percentages. Now just take the $1 million, and I'll show you the formula here. If you know anything about Excel, I know Bria said you're not the best with it, but you can make the reference to a cell absolute. That means if you copy and paste that formula, it won't change that value, that cell reference. And you do that by using dollar signs. So $B, $1 will keep the reference to B1 in our formula constant. So B1 times B9. Okay. Now, if you're like, I'm not doing that, just calculate it. $1 million times 33.33%. It'll give you the same result. Okay. But if you did do this route, you could just now copy and paste this right across, and it will then keep B1 constant. So it'll refer to the 1 million times 44.45%. C9, the value in C9. 1 million times 14.81, 1 million times 7.41. So there's all your depreciation calculations for the 4 years. This project is going on for 5 years. We're going to have a cost savings of $300,000 a year. Now, let's take a look at this. How the heck did they come up with this stuff, right? The operating cash flow. Well, each year, we're going to take our cost savings. Now, here's for the first year. Minus depreciation. Okay. So the cost savings would increase our income that would be taxed because we wouldn't have that as an expense. But depreciation expense increases our expense on our tax return. So we would actually have negative income on our tax return, which would lead us to a tax savings of almost $7,000, which would also then reduce this loss because we're going to save $7,000 in taxes. So our actual loss will be $26,333. So if you took the negative minus this minus 7,000, you would automatically, just from a mathematical standpoint, get the 26,330. So that's the net income. Now add back depreciation, which would then lead it to 306,970 cash flow. Okay. Why? Because this is negative. And then you would subtract a subtraction, right? Or I'm sorry, you would add this $333,300. So cash flow from this would be 306,970. And that's how they get, no, I'm lying. Maybe this was a little bit more. B27 to, Oh, it's off a few dollars because of the way I did it here. I think it saved it from when I did it. I didn't subtract the 69,999.30. Let me do this. Plus B27 minus B28. Okay. Plus B29 plus B26. And you can see it's taking those cells, and there we go. 306,969.70. And it's just off a few bucks because of rounding. But that's the operating cash flow. Well, that's how they got the 306,993. What they did was they put it directly in a formula up here. And here's what they said. Operating cash flow will be B2, the cost savings, times 1 minus the tax rate. So they're taking that tax shield approach to doing the calculation. I did it from the bottom up approach, down on the bottom. Then they added the tax savings from the depreciation. So you can see here, it says B10, which was your depreciation expense, times the tax rate in B3, 21%. So either way, it might be off $1 or $2. It's not a big deal. It's not going to impact your decision that greatly. So in year 2, you can do the bottom up. You can say, okay, my year 2 cost savings is 300,000. My depreciation is 444,500. That will leave me, and I'll just show you this right here, right next to it. 300,000, because I'm just going to put the numbers in. The 444,500. So cost savings, 300,000 minus 444,500. Okay, that's actually going to lead me to a loss. Multiply that by 21%. I'm going to have a cost savings from taxes of 30,345. So what's my actual loss? C27 minus C28, 114,155. Okay, now I'm going to add back depreciation. So my cash flow, 330,345. Okay, so I went bottom up. I went, here's my net income, add back depreciation. Either way, your author just took a different approach. So that's what you would do for year 3, year 4, and year 5. Subtract the depreciation, recalculate tax, determine net income, and then add back depreciation. Finally, after doing that, at the end of year 5, you have to remember one last thing. The company is going to sell this asset when they expect the salvage value to be $50,000. So how did they determine this $39,500? Based on our formula. We take 50,000. We know that's cash coming in, but we have to subtract any tax. How do we calculate that? The 50,000 we're receiving minus the book value. And there should be, actually, you could put this at the end if you wanted to, of this. Take that difference, multiply it by 21%. And that will give us the tax that will be on this salvage value. This book value is 0 because we finished calculating depreciation on all $1 million at the end of year 4. So 50,000 minus 0 times 21%. So I'm just going to do that in my calculator very quickly. 50,000 times 21%, 10,500. So 50,000 minus 10,500 will give us $39,500. That's how they determine that. That will be an inflow. That's the net inflow. We get 50, we got to pay 10,500 of tax on that 50. 39,500 is what we'll have at the end. So now we have our cash outflow and all of our cash inflows for the 5 years. Now here is the formulas. They show you that here on getting depreciation expense and operating cash flow. And you can see they take the tax shield method. Net present value then, we would calculate by taking the net present value of each of these cash flows, comparing it to the outflow. And that's what our net present value in Excel does. Or you could do this on your calculator, right? Don't forget to use brackets. And you want to use the expected return of 8%. That's what they want. Their required rate of return is 8%. Or your internal rate of return calculation by taking the information in B16 through G16, and it gives us the internal rate of return of 13.9%. So whether you use internal rate of return or net present value, it doesn't matter, you would accept this project because the net present value is positive and the internal rate of return is above the required rate of return of 8%. Remember, internal rate of return is the rate of return where net present value is 0. Are there any questions on that expanded method here? And that's actually one of the first examples they show in your book, starting on page 331. It's similar to that. An operating cash, or I'm sorry, not operating cash flow, cost savings measure. So should you do something for a cost cutting proposal? So now we're looking at different scenarios. We saw one already, replacing a machine. Now we saw this one that says, should we do this and save money? Buy this machine, and here's how it'll impact us. Is this a good idea? Any questions? All right, I think I have time for one more. There we go. All right. That's what we saw. I wanted to take a look at the last example they give. which is replacing equipment. But when you're trying to replace equipment or make a decision and you're comparing two alternatives that have different lives, notice the alternatives we were looking at, especially if it was replacing equipment, they had the same economic life to the company. Here, this company has burnout batteries, long-lasting batteries. Burnout batteries have an initial cost of $36 each, but they only last 3 years. And they cost $100 to keep them charged per year. They're expected to have a salvage value of $5 and straight line depreciation will be used. So that's just so we don't have to go into the complex calculation of makers. In our second scenario, or should we do long-lasting batteries? They cost $60 a year, but they last 5 years. See the different economic life? They cost $88 to keep charged each year. They're also expected to have a salvage value of $5 at the end, and we'll use straight line depreciation. So the machine chosen will be replaced indefinitely, and neither machine will have a differential impact on revenue. So there's no other impacts here. So we don't have to worry about any other calculations as far as what other kind of cash flow is there. They're just telling us that, so we're not worried about it. There's no change in net working capital. We expect a required rate of return on any kind of project to be 15%, and the tax rate is 21%. So I'm going to go ahead out to an Excel spreadsheet again and just show you how we could do some analysis on this. So first of all, here's our burnout. They cost $36. They cost $100 to operate a year. They have depreciation expense of $10. Yeah, $10 a year. $10. They subtract B5. Oh, because we're using straight line, we subtract salvage value when we're calculating depreciation. That's why it's $10. So if you go back to our slide when we first showed you straight line, we said cost minus minus salvage value divided by the life. So that's how we got the $10. So at the end of year one, so these last 3 years, this one lasts 3 years. We have an initial outflow, year 0 of 36. How much is our cash outflow in this case from each year? Well, it will be the operating costs plus the depreciation, 110. And now there's no savings here, okay? Because we're not looking at something from a savings perspective. We're looking for the thing that costs the least amount of money, but there's no cash savings. They're all expenditures. We will have 110 in costs, whoops, 21%. So that means a tax savings of $23.10. Okay, so if we take the 110 minus 23.10, we're pretty close. Nope, what did I do wrong? I didn't subtract something right. What did I do wrong? Come on, you're an accountant. What are you doing wrong here, Smallsy? Operating costs are 100. B4 times Z2. 21%. I'm doing something wrong. Should be 110. 23. Oh, this is cash flow, dummy. Okay. That's net income. I got to get to operating cash flow, right, guys? So to get to operating cash flow, what do? Well, this, remember, is minus 100. this is minus 10. This is minus 2310. So this is minus 8690. Okay. When I'm trying to find operating cash flow, I'll take minus 8690 and add back the $10 in depreciation. Gives me 76. Well, in this case, they have 7683. It's more exact. Mine is 7690. Sorry. So I'm off a couple pennies. Okay. But that's how we get the 7690. Whew, got a little problem there. So each year, the depreciation is going to remain the same on this asset because it's straight line. And at the end of year 3, there's $5 they're going to get back. Now, the expected salvage value. And they also calculated the after-tax salvage value to be $5. Okay, so that's given to us. So the operating cash flow going out year 0 is 36, year 1, 76.83, 2, and 3. So the first thing we want to do is calculate our net present value. What is the net present value of using the burnout batteries? 208, it's minus 208.13. So we're looking for the one that costs us the least. I know I'm running out of time here, so let me just show you long lasting. We do the same analysis. We say, okay, the initial cost is 60. Now, how much is the operating cash inflow or outflow each year? Well, the cost savings is 88, the depreciation is 11. We are then going to have a cost or tax savings of minus 21. So that's wrong. There we go. Our net income is 78. Add back depreciation. So our operating cash flow is $67 each year for 5 years. We'll get $5 back after tax salvage value right here at the end of year 5. Now find the net present value of each of those cash outflows in our case with that initial cost. So net present value for this would be 282.81. Now we don't sit here and go, oh wait, burnouts is 208.13, their negative and net present value is less than the long lasting. We can't, because we're looking at different economic lives. So what we have to do here is calculate what's called, and this is on page 336, equivalent annual cost for each scenario. Okay, equivalent annual cost for each scenario. So what we do is we take our, we actually find what would be the payment amount of the net present value for a 15% return. Okay. And it has 3 periods. So if you're using your calculator, we say, okay, if these were actually, if we convert, we have to convert net present value to payments per period. Your N would be 3, your I would be 15. Your PV will be that negative 208.13. You need to solve for payments, and they would be 91.16. So you're finding the payments in the present value of an annuity. And I know I'm running out. We do the same calculation for the long-lasting batteries because of the different time period. But in this, when we're calculating for the payment here, I'm in my finance calculator, in my time value of money solver, Now my N is 5. My interest rate remains at 15. I'm going to change my present value to the net present value of 282.81. Go to my PMT and solve. Really, the payments are only $84.37. So what we're doing here is we're trying to create a comparison where we're actually comparing apples to apples because they have different economic lives. So when we convert this to an equivalent annual cost, it's really the long-lasting batteries that will cost us less in the long run to use. So you have to take that extra step. So take a look at that in your book as well and run through the scenario there. It's a different one. And then if you have any questions, guys, just let me know. And also in my other presentation, I run through it in depth. Okay, so, but we just ran out of time. But we got through everything in chapter 10. You guys have any questions for me? All right, just really quick before I let you go. Thank you all. For those of you not with us too, thank you for a great semester. Just want to remind you, your graded problems are due for chapter 10 by Monday night, I think that is, May 11th. Final exam is due by May 12th at 11:59. And then don't forget about your project, the stock market project. It's due May 13th at 11:59 p.m. So if you guys don't have any other questions for me, I thank you. I wish you all the best of luck. Hopefully I'll see you again. And let me know if you have any kind of questions. You have a great summer too. Everybody be safe and healthy. Take care.